Okay, I know you're all studying for the test coming up. I thought we would revisit a stock dividend. Remember, a stock dividend is when you choose to issue stock. In other words, you give people stock, shareholder stock, instead of giving them cash. So it conserves cash. When you have a stock dividend, one of the first things that's going to happen is retained earnings are going to drop. Okay, retained earnings is a stockholder's equity account. It has a normal credit balance. You're going to debit it. When you issue a dividend. Uh, Remember the entry you're going to make when you have a cash dividend. Well, you don't have it here as a choice. It's going to be retained earnings, a debit to retained earnings, and a credit to dividends payable. Well, you're not going to pay a dividend. What you're going to do is issue stock. So you're going to have common stock, and you're going to have additional paid-in capital. The only time you would not have this account is if you issue it. If you issue it at exactly par, at $3 per share. So here we have 37,000 shares. On the certificate it says $3 per share. That has nothing to do with the real world. The real world's out here, $22 per share. Declares and distributes an 8% dividend. Remember, that's 8% of 37,000, not 8% of any other goofy number. So when you're doing this kind of problem, you're multiplying 8% times the quantity of stock outstanding. And then basically you're just, pretty much doing the journal entry. Let's do the big number first. The big number is how much retained earnings is going to drop as a result of this stock dividend. Well, we're going to have 37,000 shares. Let's come over here and just kind of do some math. This is how much is outstanding. And the stock dividend is, I believe, 8%. Yeah, 8%. So we're going to multiply this by 8%. That's the number of shares we're going to have as a dividend out in the world. So 37,000 times 0.08 is 2,960 shares. So the dividend, the stock dividend, is going to be this many shares. To get our big number, our debit to retained earnings, we multiply this by the market value. Obviously the market value per share, not the par value, the market value. So the problem says the current market value is $22 per share. So we're going to multiply this by 22. That times 22 is $65,120. So that's our big number. That's how much retained earnings is going to drop. Now, the credit to common stock is going to be the number of shares that we are stock dividending out times par. Common stock, remember, that entry is always at par. So it's 3, it's this amount, times 3. That's the entry to common stock. So we're going to take 2960, multiply it by $3, which is what's sitting on the certificate, and it's 8,880. So 8,880. And then the additional paid-in capital is just the difference. If you want to call it a plug, call it a plug. If you want to call it an adjusting entry, call it an adjusting entry. But basically, it's the difference between the market value times the number of shares that are going to be stock dividended out. In this case, it's 8% of 37,000. And common stock is that, again, 8% of 37,000 times par over here. So 8880 minus 65120 gives you 56,240. That's the difference. And these are the 3 accounts you hit when you do a stock dividend. Now this I kind of beat into you in class, so you should be able to get these pretty easily. Keep in mind that when you make the entry, right, let's say it didn't require you to make the entry. Making the entry, making the accounting entry is useful because then you can answer questions like the stock dividends had what effect on total assets? Well, this is the entry that was made. You need to ask yourself as a student, which of these is a asset account? Well, that's a stockholder's equity account, that's a stockholder's equity account, and that's a stockholder's equity account. No effect. What effect did it have on liabilities? None of these three are liabilities. No effect. And as I slammed into the desk to get attention in class, a stock dividend never has an impact on total stockholders' equity. It has an impact on retained earnings. It has an impact on common stock and paid-in capital. The problem is you lower stockholders' equity and then you raise it by the same amount. So again, no effect. Okay, I thought this would be helpful. Just wanted to give you a chance to, once again, when you're doing a cash dividend, you're not messing around with this whole common stock business. So this is, quite a bit easier, I believe, to get as long as you keep the $3 par straight and the $22 of market value straight. I hope you found this useful.